What is mutual funds? A question which we are trying to understand. Welcome back to our channel Study with Focus, and in today's lecture part 2, Mutual Funds, we are going to learn about some important terminologies about mutual funds, how they work, what are all the documents required to invest in mutual funds, its benefits and point to notice before investing. To gain a better understanding of mutual funds, it's important to explore how they function. New fund offer, NFO, release, asset management companies, AMCs, can introduce a new mutual fund scheme by launching its NFO. The strategy and details of the scheme are shared with potential investors before its launch. Investors can then evaluate the scheme and decide whether and how much they want to invest. NFO units are often priced at a low ticket size, such as 10 rupees. Pooling money. Once the NFO is launched, interested investors contribute funds to the mutual fund scheme in order to purchase shares in various assets such as stocks, bonds, and other securities. Investors who did not participate in the NFO can still invest in the scheme by buying its units after it becomes operational. Investments in securities. The fund manager, based on the scheme strategy, conducts extensive research on the economy, industries, and companies. This research helps them make informed investment decisions. The fund manager then purchases securities that they believe will generate optimal returns for the unit holders of the mutual fund scheme. Return of funds. As the mutual fund scheme generates returns, the gains can be distributed among the investors or retained in the scheme for further growth. Investors have the option to receive payouts if they choose the income distribution cum capital withdrawal, IDCW, option. Alternatively, if investors choose the growth option, the gains are reinvested in the scheme, allowing their investments to grow further. By understanding these functions, investors can grasp the operational aspects of mutual funds and make informed decisions about their investments. How should one invest in mutual funds? Modes of investment in mutual funds. 1. Lump sum. When you wish to invest a substantial amount in a mutual fund all at once, it is referred to as a lump sum investment. For instance, if you have 1 lakh rupees available for investment, you can choose to invest the entire amount in a mutual fund of your choice. The number of units allotted to you will depend on the net asset value, NAV, of the fund on that particular day. If the NAV is 1000 rupees, you will receive 100 units of the mutual fund. 2. SIP, Systematic Investment Plan. Alternatively, you have the option to invest smaller amounts at regular intervals. Using the above example, suppose you do not have 1 lakh rupees but can commit to investing 10,000 rupees per month for 10 months. This approach is known as a Systematic Investment Plan, SIP. It encourages regular investments of fixed amounts on a bi-monthly, monthly, quarterly, or other basis, depending on your preference and the options provided by the mutual fund. SIP promotes a disciplined investment approach and eliminates the need to time the market. Many investors try to predict the right time to invest, which often requires significant time and expertise. However, with SIP, your costs are averaged out over time, and you are not required to time the market. When the NAV is low, you will acquire more units, and vice versa. Regular SIP investments, when made over the long term, can help you build a substantial mutual fund investment corpus. The minimum investment amounts for lump sum and SIP investments are determined by mutual funds and can vary, with some starting as low as 500 rupees. Let's talk about the procedure and usual documents required to invest in mutual funds in India. 1. Through a mutual fund company's, AMC, website. A. Sign up and create an account on the mutual fund company's website. B. Follow the steps provided to invest in the desired mutual fund schemes. However, this method can be inconvenient if you want to invest in schemes from different fund houses and track your investments separately. 2. Through a mutual fund distributor. This option may involve higher expenses, resulting in lower returns. Usual documents required. 1. PAN card, mandatory. 2. Voter ID card / driving license / passport / Aadhaar card. Now let's explore the features and benefits of investing in mutual funds. 1. Diversification. Mutual funds allow for diversification by spreading investments across multiple securities and asset categories. This helps lower the risk as compared to investing directly in individual stocks. 2. Professional management. Mutual funds are managed by full-time, professional fund managers who have the expertise and experience to actively manage investments. They continuously monitor and adjust the portfolio to meet the scheme's objectives. 3. Transparency. Mutual funds provide transparency to investors. Scheme information documents, SIDs, are readily available on the fund house's website, offering details about the holdings, fund manager, and other essential information. The net asset value, NAV, of the mutual fund is published daily, allowing investors to track the portfolio's value. 4. Liquidity. Mutual funds offer liquidity as investors can redeem their investments on any business day at the NAV of that day. Depending on the type of mutual fund, the funds are usually credited to the investor's bank account within 1 to 3 days. However, close-ended funds have redemption restrictions, and ELSS mutual funds have a lock-in period of 3 years. 5. Tax savings. Investments of up to Rs. 150,000 in ELSS mutual funds are eligible for tax benefits under Section 80C of the Income Tax Act, 1961. Additionally, mutual fund investments held for the long term can be tax efficient. 6. Choice. Mutual funds offer a variety of options to meet different investment needs. Investors can choose from liquid funds for safety and low interest rate risk, flexi-cap funds for stock diversification, and solution-oriented mutual funds for specific goals like retirement or education planning. 7. Cost-effective. Mutual funds are a cost-effective investment option. By pooling investments from multiple investors, mutual funds can access a diversified portfolio that may otherwise be out of reach for individual investors. 8. Returns. While mutual fund returns are subject to market risks and not guaranteed, equity mutual funds have the potential to deliver double-digit returns annually over the long term. Debt funds can also offer higher returns compared to traditional bank deposits. 9. Well-regulated. The mutual fund industry in India is regulated by the Securities and Exchange Board of India, SEBI. This regulatory oversight ensures that mutual funds adhere to stringent rules and regulations, providing investor protection, risk mitigation, liquidity, and fair valuation. By considering these features and benefits, investors can make informed decisions when investing in mutual funds. Now, like any other investment option, mutual funds also have some disadvantages which one should consider before investing. 1. Exit load. Mutual funds often impose an exit load, which is a fee charged for redeeming investments within a specific time period, typically within 1 year from the date of investment. This fee is intended to discourage early exits as it can impact both the fund's performance and the investor's goal achievement. Compared to investing directly in stocks, this exit load may be seen as an additional expense. 2. High costs. Mutual funds have expense ratios, which are the charges levied by the fund houses for managing the funds. These expenses are capped by SEBI, Securities and Exchange Board of India, with the maximum expense ratio for equity-oriented funds set at 2.25%. However, investors have to bear these charges regardless of the fund's performance. When compared to other investment options like direct stocks, the expense ratio of mutual funds may appear higher than the brokerage fees. However, these costs are incurred for the convenience and expertise provided by the fund manager. 3. Over-diversification. In the pursuit of diversification, investors may end up investing in mutual funds that hold a large number of stocks, resulting in over-diversification. Not all stocks in a portfolio may deliver high returns consistently. It is important to review the mutual fund portfolio before investing to avoid over-diversification or investing in funds with similar holdings. 4. Market risk. Mutual fund investments are subject to market risks. Diversification cannot completely eliminate the risks associated with investing in various securities. Market risks arise due to macroeconomic and microeconomic factors. For example, equity mutual funds are exposed to volatility risk due to fluctuations in the stock market, while debt mutual funds face interest rate risk caused by changes in interest rates. It is essential for investors to be aware of these disadvantages and assess their risk tolerance, investment goals, and preferences before investing in mutual funds. Mutual funds aim to achieve the following objectives for their investors. 1. Diversification. Mutual funds help investors diversify their portfolios by investing in a wide range of securities, assets, and geographical areas. This diversification helps reduce the risk associated with investing in a single security or asset class. 2. Capital protection. Certain types of mutual funds, such as money market funds and liquid funds, focus on capital protection. They aim to safeguard the principal amount invested while providing liquidity. These funds generally have lower returns compared to other types of funds. 3. Capital growth. Many mutual funds, particularly equity funds, focus on generating capital growth over the long term. These funds invest in stocks or equity-related instruments with the objective of providing higher returns and beating inflation. However, they also come with a higher level of risk. 4. Tax savings. Equity-linked savings schemes, ELSS, or tax-saving funds offer investors the opportunity to save taxes. These funds provide income tax deductions of up to 1.5 lakh rupees in a financial year under the old income tax regime. By investing in ELSS funds, investors can reduce their taxable income and potentially save on tax liabilities. By aligning their investment objectives with the different types of mutual funds available, investors can choose funds that suit their risk tolerance, investment horizon, and financial goals. It is crucial to consider mutual funds and their schemes because they provide diversification, professional management, and access to a wide range of investment options. However, it's important to remember that investing in mutual funds involves risk. The value of investments can fluctuate, and there is no guarantee of returns. Understanding the risk factors associated with different mutual fund schemes helps investors make informed decisions and align their investment choices with their financial goals and risk tolerance. Hope you learned something new. See you in next video. Thank you.